Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed right here on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Friday afternoon is Mark Marex, Product Development Specialist with Nasdaq Index Research, to discuss Nasdaq-100 versus S&P 500 performance and composition over time. Mark, it's great to have you with us. Welcome back to Trade Talks. And the first chart tells a pretty compelling story.
Thanks, Jill. Great to be back. And yeah, I mean, I think the big question on everyone's mind is, how do you top last year, right? You can see here, at least on a total return basis, Nasdaq-100 outperformed the broader S&P 500 by about 30 percentage points. That's the biggest outperformance in about 20 years. You can see on this year-by-year chart. The only year that comes close is 2009, the big post-financial crisis recovery. And you know, with 2020 in the books now, that makes 11 of the past 12 calendar years where the Nasdaq-100 has outperformed the S&P 500. So, you know, it's got some people wondering, okay, is this the year that tech takes a back seat to, you know, value and cyclicals and maybe some other defenses? Is this finally the year that the S&P sort of gets some revenge? And that brings us to the next slide, I think.
Exactly. I was just going to ask you how the composition of both indexes have evolved over time, because as the new economy emerges, we're seeing more technology in the S&P 500.
Yeah, I mean, we talk about it a lot here, right? It's not just a tech index, even though, you know, from a pure sector perspective, it's around 55, 60% tech. The Nasdaq-100 is, you know, tech plus consumer plus healthcare. That's 90% of the index. That is more and more what's representing what the actual economy in the 21st century looks like, you know, kind of moving away from the traditional industrials, financials, materials, energy, super sector, right? You look at the left-hand side of the chart and you can see, you know, what happened in the last crisis. The Nasdaq-100 as a percent of the S&P 500, you know, went down a little bit, and the Nasdaq companies themselves, right? When you look at them as a subset of the S&P 500, the ones that overlap, they didn't move much. Compare it to the past crisis, the most recent one in 2020, huge shoot up, right? You've now got the Nasdaq-100 is 45% as an index of the S&P 500's market cap, and the companies that are in the S&P 500 that overlap with the Nasdaq-100 are 42% of the S&P 500's value. And that just makes this theory, I think, all the more difficult to really see happen in terms of trying to forecast, okay, how is the S&P 500 going to outperform going forward? You've got such huge overlap now, right, in terms of number of constituents as well as market cap, where if the Nasdaq-100 has a bad year, like odds are the S&P 500 is going to as well. And you can see that on the constituent counts on the right-hand side of the page, right? We had in that bottom section, the light blue color, that's the pure overlap. We have around, you know, 80 to 90 constituents, depending on the year, depending on the day, that overlap across those two indexes. The Nasdaq-100's got around 100 constituents at any one given point in time. That's a lot of overlap that, again, unless there's real divergence in what's in the S&P that isn't Nasdaq listed, I'm seeing a long shot here in terms of, does the Nasdaq-100 underperform this year?
Well, Mark, it's interesting, and this isn't related to your slides, but when we talk about the composition, because financials do not exist in the Nasdaq-100, whereas they do in the S&P 500. Well, now that we're seeing this emergence of fintech companies coming to market that could potentially replace financials at some point, you just look longer term out, if they might become included within the Nasdaq-100, because they are in fact technology companies at the end of the day. So I'm curious to see how your team looks at this longer term, because financials are changing at the end of the day. But let's wrap up here with a longer term picture of the fundamentals that exist now on this final chart.
Yeah, and that's a great point, right? Part of the story of the Nasdaq-100 is these tech companies coming in and disrupting other sectors besides tech, right? You think of Tesla, for example. Tesla's, you know, a tech company, but it's disrupting automakers and kind of core traditional industrials. So looking at this final page here, right? Again, it all comes back to fundamentals for me, anyways. When you look at the percent of revenue that the Nasdaq-100 used to represent versus the S&P 500, it was sub 10% in the early to mid 2000s. Now it's breaching close to 30%. That's the purple line. The blue line is the S&P 500 removing the Nasdaq-100 overlaps. Just gives you a slightly different view. In terms of earnings, look at that last year. We shot up from 40% to 80%. In other words, 80% of the S&P 500's earnings came from Nasdaq-100 companies that overlap, plus, you know, the dozen or so companies that did not. And in terms of dividends, I mean, look at that progression from 1% in 2003 to almost 25% now. It's a fundamentals-driven story. You know, sure, maybe some valuations are getting ahead of themselves in some of the frothier, growthier subsectors, but it's a fundamentals-driven story. That's why you've seen the consistent outperformance. That's why I wouldn't bet on that outperformance going away this year.
I would agree with you, Mark. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.